forward to sharing this important information with you. I'd like to draw your attention to these disclosures. Please take a few moments to review and let me know if you have any questions at the end of our Q&A. As you can see, we're going to focus on 4 key questions. How did stocks perform in 2024? What drove market performance in 2024? Where are we now? And what do major financial firms forecast for 2025? Before kicking off our presentation, I do want to talk about the elephant in the room. So a few words about Trump 2.0 are in order. I know there are a lot of competing interpretations out there, but I don't want to get mired in the politics or the culture wars. As we have discussed before, political elections rarely have long-term impacts on the direction of markets. Indeed, wealth accretion through capital markets has seen steady long-term gains, whether during Democratic or Republican administrations. We would prefer to look closely at leading economic indicators to gauge the health of the economy. We will try to understand how policy shifts could affect the economy over time. But the daily news cycle is rarely a good source of understanding of these policy shifts. For us, the most important issue at hand is a potential trade war and how it would affect the global and U.S. economies. It is not clear yet what the net effect would be. I emphasize net effect because there are pros and cons to a protectionist, pro-domestic economic U.S. government policy. Historically, tariffs have been unpopular due to their inflation effects, but today it is much harder to discern given the intertwining of supply chains in the global economy. Let's begin with a look back at Wall Street. Analysts' initial predictions for stock market performance in 2024, how stocks actually performed in 2024, and some of the factors that drove that performance. The S&P 500 closed at 5881 at the end of 2024, a gain of 23.3% above the most optimistic expectations of the major Wall Street analysts. There may be several reasons for this. One reason may have been widespread concern among economists that a recession loomed in 24, which didn't materialize. Other Wall Street strategists were concerned about valuations, while some felt corporate earnings were likely to disappoint. This all sounds familiar, maybe because of the same dynamics were in play in 23, another year in which markets strategists also underestimated how well the stock market would perform. Remember, the S&P 500 composite is an index of an unmanaged index. This is generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment. Individuals cannot invest directly in an investment in the index. Past performance does not guarantee future results. In the following slides, we're going to discuss the factors that affected stocks over the past year. As you can see, stock prices moved higher in 24 with only a few dips along the way. I want to draw your attention to a few plot points on the graph because they highlight the key storylines that drove the stock market in 2024. The Consumer Price Index stood at 3.4% at the start of the year, indicating that inflation and the Fed would be dominant market-driving factors. While stocks took a breather in April, the S&P 500 continued to rise through mid-July. Stock prices started trending lower in the late July on unemployment concerns, but the rally kicked in late August when the Fed publicly stated that the time had come to adjust its policy. At its next policy meeting, the Fed cut rates for the first time in actually 4 years. Then in early November, election results came back decisively and quickly, which helped spark a post-election rally. By December, while it was looking like the Fed had made considerable progress towards its soft landing with low inflation close to its 2% goal, there were some contradictory signals coming from upbeat gross domestic product growth, but also surprise uptick in producer prices
which persuaded market participants that future interest rate cuts could be paused. As a consequence, we saw a very sharp December correction in markets that dampened much of the enthusiasm for the year. Corporate earnings are one of the factors that drive stock prices over the long term. As the chart shows, the earnings growth for the S&P 500 companies has emerged from what market watchers call an earnings recession. That is when there's at least 2 straight quarters of negative earnings growth. As you can see, earnings growth improved steadily over the past 5 quarters, starting in the third quarter 23. Although the 5.8% earnings growth in the third quarter 24 was below the prior quarter's earnings growth, it was still very close to the first quarter of 24 and well above the third and fourth quarters of 23. As consumer spending picked up in the third quarter of 23, companies recorded positive profit growth for the first time since the third quarter of 22. What began as an earnings rebound driven by a narrow section of the market broadened out over time. Let's spend a little time getting a broader view of the economy in 24. Last year, investors and consumers cheered on the U.S. economy while also holding their breath, fearing the possibility of a recession. Gross domestic product, or GDP, started out tame but grew more robust through the year as companies continued to post solid results. As the economy kept humming, the Fed and market participants closely watched inflation. After falling to 2.4% in September, to many observers' dismay, inflation bounced up to 2.7% in October to kick off the fourth quarter. Small cracks in the economy began to emerge as the year went on. As you can see from the table, GDP growth eased slightly in the third quarter and is forecast to slow even more in the fourth quarter. The unemployment rate began 24 relatively low, but has steadily crept up this year. Consumer sentiment started the year at all-time highs, but has fallen off a bit since then. And while home builder sentiment had fallen off each quarter since the start of the year, more inventory and lower mortgage rates have helped sentiment stage a modest rebound in the fourth quarter. Despite these down-sloping trends, the good news is that many of these measures remain strong by historical standards. While the pace of inflation has ticked up slightly, it's still historically low. Consumer sentiment remains strong, as does home builder sentiment. Let's begin to look back at Wall Street's analysts' initial predictions for the stock market's performance in 24, how stocks actually performed in 24, and then some of the factors that drove that performance. To create some context about where the economy stands today, let's start by examining where we stood 2 years ago in January of 23. At the time, monetary policy was tight, inflation was elevated, and higher interest rates were dragging down the housing market. 7 of the 20 indicators were red, and the rest were neutral, with no green signs or signals to be seen. There was widespread belief that a recession was imminent. No one knew if the Fed would adjust rates, if the labor market would remain resilient, or if consumer spending would continue to hold firm. In short, the outlook was murky. Now, taking a look at January 24, exactly 1 year ago, notably monetary policy, consumer spending, corporate profits, inflation, housing and mortgages, interest rates, and the yield curve, and the leading economic indicators are all now neutral. In all, 17 of the 20 indicators are yellow, while the remaining 3, international economic outlook, equity market valuation, geopolitical risk, are red, but still no green. As we look at where the economy stands now, nearly half of the 20 indicators are green. Among them are monetary policy, the labor market, inflation. Consumer confidence has grown, corporate profits are up, and business outlook spending is positive. 9 indicators remain neutral, while only 2 remain red, equity market valuation and geopolitical risk. Let's examine one of those speedometers more closely, the leading economic index, or what I call LEI. This index includes 10 components ranging from stock prices to manufacturing orders. This data may give a clearer view of where we are when examined together. As this chart shows, the outlook trended lower since early 2022. The LEI has been accurate in anticipating 3 recessions since 2000. However, it appeared to recession in 23 incorrectly. In fact, GDP growth rose even as the LEI was painting a weaker economic picture. In November 2024, the LEI posted its first monthly gain in over 2.5 years. Now, it's too soon to tell if this upward trend will continue in 25, however. The Conference Board, which publishes the LEI, cites a number of factors that underscore the indicator's direction, including a rebounding in building permits, higher stock prices, improvement in average hourly workers' wages in manufacturing, and a drop in initial unemployment claims. So while no economic indicator is ever 100% perfect in predicting the economic future, the LEI remains an important input into developing our views about the economy in the coming months. So let's talk about some potential headwinds. Geopolitical tensions are always a concern and often an unpredictable headwind to the economy. The ongoing Ukraine war and Middle East unrest are just two examples that threaten to unsettle financial markets. Another possible headwind is a resurgence in inflation. While the latest CPI reading has been between 2 and 3% in the fourth quarter of 24, any change in momentum may be a concern. If inflation does resurface in 25, that may influence how the Fed approaches interest rate adjustments. Another possible headwind is the labor market weakness. While this has taken a backseat to inflationary concerns lately, keep in mind that the Fed has the dual mandate of pursuing the economic goals of maximum employment and price stability. In the second half of 24, the Fed shifted its focus to the unemployment situation and away from inflation. The labor market will be an area to watch in 2025 for sure. While recessionary fears did not materialize in 23 or 24 as many feared, there is some concern about an economic slowdown in 25. Consumer spending, corporate earnings, global economic weakness, especially in China, and labor market risks are all recessionary pressures to keep an eye on. Now, there are a number of potential tailwinds that may support the financial markets in 2025. One possible tailwind is artificial intelligence. While AI was a steady influence in 24, some see continued interest in AI throughout 2025. There are a couple of reasons for this. First, AI-related concepts have more room to broaden out in the economy. While most of 2024's AI was driven by tech companies, in 2025, many expect advances in industries outside of Silicon Valley. Second, if AI turns out to represent a quantum leap akin to the Industrial Revolution, there may be a lot more room for growth, especially if AI drives productivity. Another potential tailwind may come from a jump in the form of improved corporate profits as companies across all sectors and industries embrace artificial intelligence. It's hard to think of tailwinds without thinking of the Federal Reserve and its shift to monetary easing last year. As the effects of looser money supply continue to filter through the economy, Fed policy could be a potential tailwind in 2025 as well. Before discussing the 2025 forecast, let's examine this chart to see where stock prices trend against historical averages. The most common way to do this is look at the PE, or the price to earnings ratio, which measures investors' willingness to pay for a company's earnings. Looking at the dotted line in the middle, you can see that the PE ratio for the last 30 years is, on average, 16.9. You can also see that the PE moves quite a bit, with a peak near 1999 and a trough in 2008. This chart shows that the PE ratio was over 22 by the end of November. Does that mean stock prices will head lower or climb in the months ahead? Well, while a PE of 22.2 is more than one standard deviation above the 30-year average, it's still a difficult question to answer. Now let's take a closer look. There's a significant premium for the largest stocks. As you can see from this chart, the 10 largest S&P 500 stocks are trading at 29.3 forward PE ratio, significantly higher than the broader market. This premium is distorting the overall valuation of the S&P 500, making it appear more expensive than it might be for most companies in the index, which means there's more reasonable valuations for the rest of the market. The other 490 stocks in the S&P 500 traded a much lower 18.3 forward PE ratio, which is closer to historical averages. This suggests that the typical stock is more reasonably valued, highlighting the disparity between the mega cap stocks and the broader market. The key takeaway here is that investors should be careful interpreting what valuation means, as like the PE of an index. and also that there are benefits to diversifying one's investment exposure beyond a simple purchase of an index like an S&P 500 ETF. Another way to look at this is by studying the S&P 500 equal weighted index. The traditional market cap weighted index for the S&P 500, which we've generally been looking at so far, gives more influence to larger companies like Apple, Microsoft, and Amazon, meaning their performance disproportionately affects the overall index. This can lead to concentration risk, where a handful of mega cap stocks drive most of the index's gain or losses, potentially masking broader market trends. For example, if the tech giants are thriving but smaller companies are struggling, like we've kind of seen in the last 18 months, the market cap weighted S&P 500 might still show strong performance even if the average company isn't doing well. On the other hand, the equal weight version of this S&P 500 assigns the same weight to each of the 500 companies regardless of size. This approach provides a more balanced view of how the average company is performing, offering greater exposure to mid-cap and smaller large-cap stocks. It tends to outperform environments where broader market participation occurs, as gains are more evenly distributed across sectors and companies. So if we're looking at the average company in the index, valuations do not seem so stretched, but the indication that you may want to maintain some exposure in mid and smaller large-cap sectors. Now, moving on to the forecast for 2025, let's begin with a look back at Wall Street's analysts' initial predictions for the stock market's performance in 24, how stocks performed in 25, and some of the factors that drove that. Before discussing Wall Street's analyst predictions, let's examine some important inputs that may impact the stock market's direction in the coming year. As many of you know, corporate earnings may be a key driver of stock market performance in 25. According to FactSet, a leading financial data and analytics firm, earnings are expected to continue trending higher in 25. While this is a good sign, it's also difficult to say how much of that earnings growth expectation has already been priced into stocks, especially in light of their current valuation levels. Estimating quarterly earnings is difficult, but such estimates can help guide decisions about what price to pay for a stock or even a sector or index. If earnings are healthy, it may support higher prices. Conversely, should earnings come in short of expectations, it may put downward pressure on stock prices. Oops, there we go. Okay. I want to talk briefly about the Mag 7 and its impact on valuations and their earnings expectations. In 23, the Magnificent Seven, or Mag 7 as we call them, companies posted an impressive 34% EPS growth, significantly outpacing both the S&P 493 at negative 4.4% and the Russell 2000, which is largely mid-cap stock, at minus 11.7%. This superior earnings growth has been a key driver of the Mag 7's market outperformance, highlighting their dominance in the broader equity landscape. But earnings growth convergence is expected. The gap in earnings growth between the Mag 7 and the broader market is projected to narrow over the next 2 years. By 2025, Mag 7's EPS growth is expected to slow to 20.8%, while the S&P 493 is expected to catch up with 12.7% growth. The Russell 2000 is projected to surge ahead with 44.5% EPS growth, indicating a potential shift in market leadership. As the Mag 7's EPS advantage dissipates, there's an expectation that broader equity markets, particularly mid and small cap stocks, could take on leadership roles. The bottom-up consensus suggests that this trend could drive more balanced market performance, reducing the concentration risk currently posed by a few mega cap companies. So what are the implications for investors? Well, investors might consider diversifying beyond the Mag 7 to capture potential gains in the broader market. The anticipated strong rebound in the Russell 2000 indicates opportunities in smaller and mid-cap stocks, which could benefit from improved earnings outlook and shifting market dynamics. Moving on to inflation and interest rates. The Fed's decisions about interest rates may have some influence on stock prices in 2025. One tool traders look to understand where rates might be heading is the CME FedWatch tool, which analyzes the probabilities of future target rates as implied by the 30-day Fed funds future pricing. If we look at where the markets think the Fed is going, we see that markets believe there is a 45% probability of the federal funds rate falling by 25 basis points or 1/4 percentage point by the end of June. In late December 2024, the Fed funds was 4.25% to 4.5%. Traders also see a 28% probability for the rates to remain unchanged within the first 6 months of 2025, while there's about a 22% likelihood of the half percentage point cut. There's only a 4.4% chance that rates will fall 3/4 of a percentage point, and less than 1% chance the Fed will cut 1 full percentage point by mid-year. The Fed signaling in the fourth quarter of a more cautious, hawkish approach to rate adjustment means that the next 6 months may be quite different than the past 6 months with respect to Fed policy. I want to talk briefly about the impact of interest rates on the tightening of yields. Following the strongest tightening cycle in 40 years, bond yields have risen significantly, leading to historically attractive five-year return potential across various bond categories. And what I mean by 5-year return potential, it's basically after this tightening cycle and the increase in interest rates, how will various sectors of the fixed income market perform over the next 5 years. Even traditionally lower yielding assets like short-term bonds and U.S. Treasury bonds show competitive returns of 4.05 and 5.64% respectively. This is the best time to be investing in bonds probably in the last 15 years. While inflation is still a potential risk, an investor willing to carry bonds to maturity can actually earn some very good interest right now. And this has been a very great improvement in fixed income returns and how they impact both the performance of balanced portfolios and also the performance of pensions and other types of retirement plans. Also, should be noted that if the economy experiences a slowdown or even a mild recession in the next 6 to 8 quarters, bonds will typically perform well as a counterbalance to falling stock prices as investors seek safety in fixed income investments. Economic forecasters surveyed by the Philadelphia Fed in the fourth quarter updated their fourth quarter outlook in all of 2025. They substantially increased their expectations for fourth quarter 24 real GDP growth to 2.2% from 1.7%. In 2025, they anticipate positive growth each quarter and forecasting 2.2% overall real GDP growth for the year. So at this point, no recession appears in the forecast. Interestingly, their unemployment rate projections remain essentially flat throughout 2025, with only a very slight upticks in the second and fourth quarters. It'll be interesting to see how or if economic growth influences the unemployment rate. Another important trend to look at is the continued improvement in U.S. productivity. This is important because high productivity generally translates into economic growth and shows up for investors as higher corporate margins and profitability. So improving productivity can be seen as potentially supporting the bull market for equities going forward. Post the great financial crisis, or we call it GFC, we saw a productivity rebound. U.S. productivity experienced a significant decline after the GFC, with the 2010 to 2019 average dropping to 1.3%, well below the historical average of 2.3% from 1950 to 2009. More recently, productivity has shown signs of recovery, moving back towards the long-term average, signaling potential for stronger economic growth going forward. While the benefits of artificial intelligence have not yet fully materialized, this new technology holds the potential to unleash a sustained productivity wave similar to the internet revolution. If AI delivers on its promise, it could significantly boost productivity growth in the coming years, driving innovation and economic expansion. Aside from interest rates, inflation, and productivity, one of the most critical factors that may decide how the economy and the stock market do in the year is the health of the consumer. Consumer spending represents about 2/3 of the American economy, and if consumers pull in their spending in 2025, it could have consequences for the markets. As we can see in this chart, the amount of liquid wealth has declined over time, while credit card delinquencies have trended higher. And this is particularly due to the lower quintile of consumers. Will the combination of shrinking liquid net worth and rise in credit card delinquency influence consumers' spending habits? It's actually difficult to answer, but the consumers have been known to surprise the experts. Another factor we look at, getting back to kind of post-GFC deleveraging, after peaking around 2008, household debt as a percentage of disposable income experienced a significant decline due to the post-GFC deleveraging efforts on the part of households and companies. As of 2024, household debt levels have stabilized around 93.9% of disposable income, indicating that this deleveraging cycle is largely complete. With household U.S. net worth increasing by $49 trillion since 2020, consumers are now in a stronger financial position to sustain spending. This improved financial health supports the potential for steady economic growth as consumers are better equipped to contribute to the broader economy, even as conditions normalize. So what are the major financial firms forecasting for domestic stock prices in 2025? Analysts are predicting a relatively bullish year for stocks in 2025. However, unlike the past 2 years, you'll notice a tighter range in these forecasts, running from 6,500 to 7,000. The S&P closed at 581 on December 31st. It's currently around 6056, and based on the forecast shown above, the lower bound forecasted return is approximately 7.3%. That's coming from JP Morgan, Morgan Stanley, and Goldman Sachs. And the upper bound forecast is expected to return approximately 15.6%, based largely upon the 7,000 from Deutsche Bank. This tighter range of sentiment may be attributed to many a variety of issues. Will geopolitical tensions hold back market momentum? Will the Fed continue to adjust rates or tap the brakes until it is more confident that inflation is under control? Will the economy see a soft landing or slip into recession? And how will corporate profits look in 2025? Well, these were all issues that the strategists wrestled with in the past. There seemed to be greater optimism and less divergent opinions. I want to end our discussion with a word on the importance of investment discipline, or sticking with your investment strategy. The potential of stocks to help build wealth over the long term may be challenging when investors move in and out of financial markets. If we look at this image, we see a direct correlation to the probability of having positive gains in stocks with the time such investments are held. For instance, over the last 96 years, 73% of all one-year periods had positive returns. However, if we travel out to longer holding periods, we see the likelihood of investment success rise to 84% in 3-year periods, and 88% for 5-year periods, and 94% for 10-year holding periods. As the old saying goes, what is important is time in the market rather than timing the market. While APS will make tactical repositionings along the way as we manage the portfolios, our focus is always to keep you invested in the most appropriate risk-adjusted portfolios that are catered and customized for your risk profile. So steps for you to take. What you can do in 2025 as you move closer to your goals is, if your life or personal situation changes, we want to be kept in the loop. We want to hear about important family events, births, deaths, marriages, job changes, all those things to help us keep abreast of your current situation. We also care about health issues, any financial developments that might be changing your situation. If you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us. We can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like risk tolerance shifts or market environment concerns. As always, we're here to discuss any financial questions or worries you might have. Our priority is always to keep you well informed. Now, steps for us to take. we're going to focus on delivering the following. We'll keep you informed through regular communication. We'll manage your investments according to your personalized strategy, and we'll remain abreast of economic factors and adjust accordingly. At this point, I want to open it up to any questions, and maybe if Hiromi, you can unmute anybody who has a specific question so that I can answer them.
The recent big LA fires made me wonder, should I be taking into account climate change as a factor in planning future finances?
Well, that's a very good question, Larry. So climate change is obviously an important concern, right? Like it's on a lot of people's minds, and with the warming trend continuing globally, there's obviously going to be some pretty significant ramifications of that. From a market-based perspective, there could be obviously some real losers, right? Think property on low-lying coastal areas, but there could be some real winners too. So certain technologies to enable us to better adapt to those changes. So it's hard to know strictly from an investment point of view or even an economic point of view. Having said that, though, one thing that does affect all of our personal financial situation is insurance premiums, right? So as climate change could potentially affect how the cost of insuring our properties, and for most of us, that's our real property, like our houses and other real investments like that, land and businesses and things like that. So the cost of insurance could be a factor. And as insurance companies experience higher losses, or if they experience higher losses, that could potentially affect the cost of ownership, right? The cost of insuring and things like that, which needs to be factored into budgeting decisions, especially as you're heading more towards retirement. So yes, I think it's something that we really need to keep a close eye on, and we need to, with the way we need to factor in is in things like that. Higher premium costs, how's that going to impact my financial situation? And we can help you by building that into your model. We can do some stress testing of that to see if you're financially prepared for any like spikes in premiums and things like that. So that's a very good question. I think it's definitely more of a financial planning question than, it's at least easier to address from a financial planning side than it is, say, from a direct investment side, because we don't know the net effects of climate change on how and which companies will perform or respond or adapt. I know that's maybe not the best of answers, but hopefully that gives you some, clear ideas of how we're viewing it, at least. Okay. So I want to thank everybody for your time today. As you can tell, we're passionate about helping you understand the markets. As difficult of a task that is to even understand what the markets are telling us. For more information, timely updates, follow us on our social media page. We do post a lot there. Contact us at any time. Our website, if you need to have a quick meeting with us, you can book that on directly from our website. And if there's, obviously any other pressing concerns, please reach out to us as soon as you can. With that,
Reggie Porter, if I may, I was trying to get off mute to ask a question and couldn't get off quick.
Okay.
Real quick question about concerning with AI and looking at Palantir and government contracts, seeing how you looked at it, fitting in the market, and if there's been any look at that. I know there's some other companies going public. Just seeing what you guys look at in terms of that defense contract and AI, where it plays, and what companies might be coming up.
Okay, so that's a good question. I think that I think that refers to a little bit like what the potential benefits of. Now, I'm not going to speak on Palantir Technologies or any company specifically, but what I can say is, as well, initially the hype around AI and driving, NVIDIA and all that stuff has been around the actual like creation of the large language models themselves and kind of what they can do. The the productivity improvements that I was referring to that could potentially expand margins, grow profitability, and make workers more productive, right? Generally, that's generally good for the economy. It's not just good for corporate profits, it's generally good for wages too. As productivity rises, so do wages, right? And then that expands economic growth. So to the extent that, and in the coming years, we see other companies, service companies, business services, consumer services, use AI to improve goods and services in the economy, I think that's going to be a very positive thing. And then we're still at the very beginnings of it. You know, if you were around in 2000, we were all kind of like there with the internet craze, even though a lot of like those initial internet companies went bust in the crash, the dot-com bust. Out of that came some tremendous amounts of productivity. We had sustained productivity gains for a while, and in fact, even before 2000, we were experiencing those gains probably from 1990 onward. So we probably had a 10 or 15, maybe 20 year of outsized productivity gains, which helped grow the economy and propel market performance. That obviously came to an end with the deleveraging that started in 2008 in the great financial crisis. But I think we could be on the cusp of something new because it's a new way of using technology. It's a new way of accessing information. It's a new way that it's just really hasn't been explored yet. So we're really bullish on it. We have specific sector-based AI positions in our models that we run. So that's a really important part of our long-term investor thesis, not necessarily the short term, but longer term, because I do think the runway that you're looking at for this technology to enter into the broader economy is going to be longer than 5 years, probably 10 years, maybe 15 years. So, but we're very optimistic about the impact on productivity and how it's going to affect the economy. Great question, though. Are there any questions? I know maybe it was difficult to unmute, but if anybody has one, I would love to hear it. Okay, great. Thank you so much, everybody, for joining us. Again, feel free to reach out to us if you have questions, particularly as it relates to your personal situation. And we hope you enjoyed the presentation today. Hopefully it gave you some good and valuable information. And until next time, everybody be safe and stay calm above all things. Okay, take care.